On March 11, 2025, Wall Street was rocked by a $1.7 trillion market meltdown, the worst single-day collapse in years. The Nasdaq crashed. Tesla stock plummeted 15%. The S&P 500 dropped like a stone. 2 weeks later, March 28th, another brutal sell-off. This time the culprit was clear: inflation. Americans were spending less, and when spending slows, earnings drop. And when earnings drop, stocks crash. Markets in chaos. The White House in panic. And at the center of it all, a seismic shift that could rewrite the world order. Japan, the Far East's high-tech hub and the financial stronghold of the U.S., is secured by treasury bonds. Tokyo has been Washington's most consistent bond buyer for decades and has recently been in the spotlight for its efforts to break the dollar monopoly. American tariffs have prompted the Asian giant to shake up U.S. markets by selling its substantial stock of treasury bonds. As Japan loses its own financial umbrella, the U.S.'s position in global balances is being dragged down by this move. Japan's tendency to convert its foreign exchange reserves into various currencies is even more striking when coupled with the fact that the U.S. stock market has recently lost over $1.7 trillion in total. By 2024, Tokyo is expected to hold more than $1 trillion in bonds. If Tokyo were to fully deploy this bond-selling strategy, it is believed that Washington would be impacted in numerous areas, from interest rates to employment. In fact, the historical trend was the opposite of the current scenario. For years, Japan was one of the largest purchasers of U.S. Treasury bonds. These bonds are essential for Washington to finance its public debt. However, recent leaks from the Japanese Finance Ministry indicate that the Tokyo government has sold off a substantial portion of these bonds. Could such a massive sale really undermine the dollar's global prestige? Let's first examine the origins of the issue. Since the 1980s, Japan has been one of the dollar's biggest supporters by investing its trade surplus in U.S. bonds. However, when the U.S. administration, particularly under Trump, introduced tariffs, Japan sought to leverage this financial weapon. If you impose tariffs against us, then we will sell your bonds, which represents a new breaking point in the relationship between the two countries. At this point, Japan's abandonment of the dollar is being read as a kind of retaliation against the U.S. During his previous presidential term, Trump was known for his protectionist trade moves based on the America First slogan. Donald Trump has now imposed heavy tariffs against Asian countries, especially in the areas of automotives, steel, and technology. Japan is one of the most affected by these policies because Tokyo is a huge exporter in the global automobile and electronics trade. Japan, which competes fiercely with China, also has a deep alliance with the United States. But Trump's tariffs have undermined this friendship. Protesting the tariffs, Japan first objected diplomatically, then signaled that it might impose additional tariffs on American products in its own market. However, the real weapon is Japan's huge portfolio of treasury bonds. This portfolio is vital in financing the U.S. public debt. Even if the sales were small, the assessment that they would raise interest rates on U.S. bonds, weaken the dollar, and shake the stock market found a voice in the Tokyo bureaucracy. At this point, leaks from the Japanese Finance Ministry fueled claims that Japan was selling U.S. bonds. To understand the significance of this sale, we must first clarify the role of U.S. bonds. The U.S. Treasury can borrow at low interest rates because investors worldwide trust the dollar. Large-scale buyers like Japan help sustain this cycle. If Tokyo reduces its holdings of these bonds, the U.S. may be forced to pay higher interest rates. In turn, higher interest rates could slow the growth of the U.S. economy by increasing the cost of credit for both businesses and consumers. In addition, investors who have turned to the stock market may sell their stocks, reasoning that with rising bond yields, there is no need to take on the additional risk of equities. This could result in a depreciation of the stock market. Economic circles have long speculated about Japan's desire to diversify its dollar-denominated assets. The inclination to shift towards instruments such as the euro, the British pound, or gold is seen as a strategy to reduce dependence on the dollar monopoly. International media outlets, citing sources close to Japan's high bureaucracy and finance ministry, report that Tokyo is gradually reducing its holdings of U.S. Treasury bonds. Headlines have highlighted that both Japan and China began selling U.S. bonds even before Trump's victory. When all this information is considered collectively, the narrative that Japan is moving away from the dollar gains traction. While Japan has not officially declared an abandonment of the dollar, Tokyo appears to be positioning itself for a multipolar financial world. So, why did the $1.7 trillion figure emerge? The additional tariffs imposed by the Trump administration during its second term exacerbated an already tense global trade environment. While Washington introduced protectionist policies it claimed would revitalize the American economy, Canada, Mexico, China, and European countries responded with retaliatory tariffs, creating a chain reaction. Now, Japan's alleged shift away from the dollar has become another link in this chain. The most market-shaking news, however, was the recent $1.7 trillion loss in the U.S. stock market, which sent ripples of uncertainty across the financial world. When the Trump administration faced this scenario, it had to confront a pressing question. Were they prepared for such a crisis? The dollar's once unshakable position was being tested by sell-offs from key players like Japan, China, and Europe. Meanwhile, retaliatory tariffs from Europe, Canada, and Mexico further complicated the situation. The European Union imposed tariffs on American whiskey, motorcycles, and agricultural products. Mexican President Claudia Sheinbaum heightened tensions by proposing to lower tariffs on Chinese goods to match U.S. levels. Canada also joined the fray, announcing retaliatory tariffs on U.S. steel and aluminum. In short, entire continents were plunged into an escalating cycle of tariff wars, amplifying the strain on global trade dynamics. The impact of additional tariffs struck the stock markets like a bomb. The U.S. stock market, which began the week in decline, suffered one of its biggest losses in recent years, with a staggering $1.7 trillion wiped out. Technology stocks were hit particularly hard. Tesla alone lost $125 billion in a single day, while industry giants like Apple and Nvidia saw declines of up to 5%. While Trump dismissed the downturn as a temporary blip, some analysts warned of a potential recession. They argued that the president's pro-growth stance might not be enough to stabilize the markets in the face of escalating trade tensions. That week, the Dow lost nearly 900 points, the S&P 500 dropped 2.7%, and the Nasdaq Composite fell 4% as major tech stocks continued their sell-off. Tesla's shares plummeted by 15%, while other Magnificent Seven stocks, Apple, Microsoft, Alphabet, Amazon.com, Nvidia, and Meta Platforms, declined between 2% and 5%. Investors are increasingly concerned that the US's escalating trade conflicts with key partners will slow economic growth. As countries like China, Canada, and Mexico impose retaliatory tariffs and partially restrict American imports, domestic prices in the U.S. could rise. This, in turn, may heighten inflation risks and shrink export markets for American companies, adding further pressure to an already volatile economic landscape. Although Commerce Secretary Howard Lutnick urged against exaggerating fears of a recession, the markets painted a different picture. The steep mid-February decline followed a tumultuous week, with growing concerns about how the administration's erratic tariff policies might impact U.S. economic growth. The S&P 500 ended the week down 3.1%, marking its biggest drop in 6 months. The 10-year U.S. Treasury bond yield, which began the week at 4.213%, had closed the previous week above 4.31%. Meanwhile, the Wall Street Dollar Index hovered near its lowest level since early November, but suffered its sharpest decline in over 2 years due to escalating economic and foreign policy uncertainties. As the U.S. grappled with economic volatility, Japan's resilience allowed it to navigate the situation strategically. Tokyo's greatest leverage isn't limited to bond sales. With its robust exports of automobiles and electronics to the U.S., Japan could impose retaliatory measures, such as new quotas or taxes on American goods in its own market. For instance, additional taxes on U.S. agricultural imports could severely impact farmers, particularly in the Midwest. So why did Japan choose Treasury bond sales as its most drastic move? Because it's a far-reaching pressure tactic that affects the entire U.S. economy. American politicians are acutely sensitive to losses in voter stock markets and pension funds, which could spiral if there's a perception of a weakening dollar. This calculated move by Japan amplifies its influence, targeting the broader financial stability of the U.S. economy. The Trump administration risks facing backlash not only from farmers, but also from the financial sector. This is where Japan believes it can pressure Washington, delivering a stark message. Stop your protectionist policies, or we'll continue liquidating our bonds. This strategy represents a new form of financial warfare in international relations. But wouldn't Japan also suffer losses from such sales? Critics often argue that large-scale sell-offs would lower bond prices, reducing the value of Japan's remaining portfolio. While this is true, the question is whether Tokyo is willing to take that risk. It's possible Japan's leadership views the long-term risk of remaining tied to the U.S. as far greater. By selling only a portion of its reserves and gradually reducing the rest, Japan could aim to mitigate its losses. Additionally, Japan's own economic situation plays a role. With its economy mired in low interest rates and deflation for years, the country heavily depends on exports and foreign investment income. For Tokyo, diversifying its financial strategies might be a calculated move toward greater economic independence. Some argue Tokyo wouldn't benefit from cutting ties with the U.S., but tariffs have already strained Japan's exports. Using bonds as leverage is a logical response. Tariff blackmail met with bond blackmail. Japan's shift from the dollar, alongside moves by China and others, has sparked debate about the dollar's dominance as a global reserve currency. While experts say no strong alternative exists yet, mechanisms involving the euro, yen, or gold suggest a slow shift toward a multipolar monetary system. Japan's push to reduce its dollar dependence is gaining traction in Asia. Countries like South Korea, Singapore, and ASEAN nations may also seek to diversify their reserves amid U.S. tariffs. This doesn't mean the dollar will be replaced, but it does signal that the U.S. may no longer wield its financial power as freely. Tokyo has proven it can shake markets with a single move. Similarly, reports suggest China began cutting its U.S. bond holdings during the Trump era. If Japan and China, the world's two largest bond buyers, sell simultaneously, the ripple effect could be a financial tsunami. The U.S. Treasury is facing a tough challenge, finding funds to stabilize the economy amid bond sell-offs. A rapid rise in interest rates could shake inflation and unemployment, despite Treasury officials downplaying concerns. However, private sector experts warn that danger is looming. Japan and China, inspired by each other, are sending a clear message. Unilateral protectionism is putting U.S. financing at risk. While China's move isn't surprising, Japan, a longtime ally seeking to reduce its dollar dependence, could weaken U.S. geopolitical power. The dollar isn't just a currency, it's a tool of influence. Nations with large dollar reserves are more vulnerable to U.S. sanctions. By diversifying, Japan signals a shift away from that dependency. Could this challenge U.S. military influence in Asia? Some analysts believe Japan's security alliance with the U.S. remains intact, but if Tokyo loses trust in Washington, regional military dynamics could change. Increased defense spending and independent strategies might weaken the U.S.'s role in Asia. Public sentiment in Japan reflects this shift. While the U.S. relationship has long been strategic, Trump's tariffs have fueled resentment, particularly among automakers and tech firms. Some believe bond sales are Japan's way of pushing back, despite risks to yen stability. Yet Washington has not imposed sanctions, perhaps fearing that too much pressure could push Japan further away. How will the U.S. respond? While Trump's protectionist stance remains strong, even a future administration may struggle to restore trust. If Japan continues reducing its dollar reserves, reversing course won't be easy. Some U.S. politicians may advocate for easing tariffs to mend ties, but Tokyo could stand firm, using this as leverage. Investors worldwide are taking note. Japan's actions have sparked fears of a broader sell-off, prompting central banks in China, Saudi Arabia, and Europe to reassess their U.S. bond holdings. Financial giants like J.P. Morgan and Bank of America are analyzing whether this is a temporary shock or a deeper transformation. So, who stands to gain? Japan risks straining its relationship with its largest export market and security ally, but it also wants to prove it's not powerless against U.S. policies. More likely, Japan isn't aiming for a full break. It's positioning itself to negotiate better terms. What do you think? Did Japan's bond sales really trigger a $1.7 trillion loss in the U.S. economy, or is this overstated? Is Trump's team worried, or can a compromise be found? And how will Japan's shift affect global trade and financial markets? Share your thoughts in the comments, and thanks for watching.